According to supply managers in the 9 Mid-America states, how is the economy performing?
Our May survey of supply managers, manufacturing supply managers in 9 states, the Mid-American region stretching from North Dakota, Minnesota, north to Oklahoma and Arkansas in the south. The overall reading remained above growth neutral for the 4th straight month. That's the good news. The bad news is it's still only slightly above growth neutral, down from 54.8 in April to 51.3 in May. So that's still moving along. I'd call it very slow growth we're looking at ahead. The GDP, of course, for Q1 for the U.S. number was only 1.3%. So this is continuing that slow growth trend for the region. So it was a good report, a reasonably good report. I can't call it a good report, but it was certainly better than what we've seen in the latter part of 2022. The Mid-American is likely to continue to grow, in my judgment and my estimation, using these numbers, but it's going to be at a slow pace. GDP will be continuing to move forward. There'll still be labor hoarding, so the employment numbers will look better than the GDP numbers, the overall growth number. Approximately 4 out of 10 of the supply managers reported a negative outlook for the next 6 months. So I bring up the graph of the Mid-American region compared, and these are called PMIs, Purchasing Management Indices, and you'll see there in blue the Creighton number, and red, which will come out later on this morning, the national number, and it of course is below growth neutral but moving upward a bit. So both numbers are hovering around growth neutral. Both numbers are really pointing to slow growth in the weeks and months ahead.
What were the hiring trends?
May hiring was up slightly. The overall index was above growth neutral, moved to 52.3 from April's 52.2. So up very slightly. Almost 1 of 6 reported job gains for the month. That's about the same as it was in April. Lots of labor hoarding out there, and that's causing productivity numbers to go down. In other words, we're recording very low productivity readings for the region and for the nation. And that's because you've got these workers, the companies are just fear letting those employees go, and thus they retain them even when there's not sufficient work for them to do. And in fact, the last 3 months, though, we saw job gains for the region at 1.4%, and that's not bad compared to U.S. 2.2. So the job number is looking good, but again, that's a lot to do with labor hoarding.
What inflation trends are you noticing?
The overall reading was 74.0, and that's up from April's 67.4. So keep an eye on these numbers, keep an eye on the month-to-month changes in our reading, but also the CPI and the PPI, that's the Consumer Price Index, Producer Price Index. Over the last 3 months, the CPI has been up 0.9%, and that's pretty good. That's still above the Fed's target. The PPI actually down 0.2%. So things are looking better on the inflation front, but not good enough for the Federal Reserve. And when we asked the supply managers about prices that they paid, and they over the last 12 months, they reported 5.6% increase in prices. And we asked them, the Creighton survey asked them about looking forward for the next 12 months. It was almost half that. Actually a little more than half of that at 2.9%. So inflation behind us was very high. Looking forward is still a bit above what the Federal Reserve would like to see. So again, it's very sticky, has not come down like the Federal Reserve would like for it to come down.
What is the economic outlook?
Outlook is still slow growth, but there's some sectors that's going to be negative growth, and that's commercial real estate, that's office space, particularly office space, and particularly in downtown areas of the region. That would be whether that's St. Louis, whether that's Omaha, whether that's Minneapolis. You're going to see open spaces there, unrented office space. Also, banking and finance is just having a tough go of it with short-term rates very high compared to long-term rates. So the banks are having to pay high rates, but when they lend it out, they're getting lower rates. So that doesn't work, of course. The CPI month over month, I expect it'll come in when the May number comes in. I think it'll be about 0.4 percentage point. That's still above the what the Fed would like to see. Again, they want to see 2% for the year, and of course that maps out something like 0.2% for every month. Long-term interest rates are beginning to move higher. The 30-year mortgage rate is now above 7%. I expect the 15-year mortgage rate to rise above 7%. So mortgage rates are getting higher out there, and of course that's not good for those who are buying homes. And what it means is those who are in their homes at these very low interest rates they've got on the old mortgages, they're going to stay in place. So what we're seeing out there is a lot of individuals, they are not moving and they're staying in their homes. So that's what we're going to continue to see. Keep an eye on the bond market. The bond market is where the action is going to be. It's going to be telegraphing to you and to me and everyone else out there what's going on in the economy. If that yield comes down, that's the yield on the 10-year, which I don't expect it to, but if it did come down, that's indicating movement towards slower growth and potential recessions. Keep an eye on the ISM reading, which will come out later on this morning. That number is likely to move upward. Now, it's not going to break growth neutral 50, but it's going to be still upward in my judgment. That's indicating that the manufacturing sector is holding up, much like our regional number is holding up. So those are some things you need to watch out for going forward. In addition, of course, to the price of a barrel of oil, which has now come down fairly significantly, and that's just indicating that the global economy is slowing down and the U.S. economy is slowing down as well. A lot of that can be traced to labor productivity is just down significantly. The worst period of labor productivity in the U.S. since 1947. So, and this is, of course, we've getting a lot of job growth, good job growth, and businesses are hoarding employees, of course, and the reason they're hoarding them, they don't want to let them go. So a lot of those workers, it's called quiet quitting sometimes. It's not quiet quitting. They just don't have the business activity necessary to keep them busy, but they don't want to let them go. So they're keeping them on, which means jobs look pretty good, but the overall GDP number, the overall growth numbers don't look so good. So that's what we saw in our month of May here at Creighton University. Until we meet again, the first business day of July, may your economic cup runneth over. Thank you.